Hi, and welcome back to the Business Career College video series. What we're going to look at today is coverage related to Assuris. So we're going to look at the protection that's offered to consumers because of insurers' participation in Assuris. This is information that you will need for the LQP course. This is useful also if you're going through preparing for the FPE1 or FPE2 exams. So Assuris protection would work in this instance. We have an insurer here, and this insurer is required to report its reserves. We have a fairly complex concept here called MCCSR, Minimum Continuing Capital and Surplus Requirements. This is the insurers reporting to the Office of the Superintendent of Financial Institutions, or OSFI, basically assuring OSFI that there's enough money here to pay out claims to clients. Insurance is not a Ponzi scheme. It has to be funded in advance. We actually have to have money here in these reserves in order to make this work. So now, if these reserves are inadequate, then what happens here is the regulator, OSFI in the case of federal insurers, or the relevant provincial regulator in the case of provincially incorporated insurers, says, okay, if this is inadequate, now insurer, you're going to have to go into bankruptcy. Okay, bankruptcy being a legal position where we can't pay out any amounts of claims that didn't already exist when we went into bankruptcy. So this means existing creditors are the ones who are going to get paid here. Oops. So our existing creditors only get paid. So the problem here is, what if we have a new claim during this time? Well, this is exactly where Assuris steps in, and Assuris will pay these new claims. Okay? And what happens then at the same time is we have this trustee in bankruptcy, and the trustee in bankruptcy is going to work with Assuris to try and sell the assets. And we have had an instance of this fairly recently in Canada, where we had a provincially incorporated insurer in 2012 in Ontario, a company called Union Life Assurance of Canada, and Union Life went broke here. They had inadequate reserves, and in 2012 they had to deal with all of this, and we did see in that case Assuris step in, and this process worked exactly as it should have. The assets have been sold. A company called La Mutuelle out of Quebec has now acquired those assets. So now the question is, when Assuris steps in, what benefits does Assuris provide? Well, Assuris is going to provide benefits that are designed to at least compensate the policy owner for a claim that should have been paid. Now, it's really like Assuris is acting like the insurer here. And it's only during this time, this period of bankruptcy, that Assuris has to get involved. After the assets are sold, now the new insurer takes on the promises, collects the premiums, and so forth that the original insurer had promised. The Assuris here, every insurance company in Canada belongs to Assuris. There are a few entities that don't. The fraternal benefits organizations like Knights of Columbus, for example, do not have to belong to Assuris. And they have different ways of reporting their reserves and different requirements. Anyways, a bankruptcy there is far, far less likely. So what happens then, and not that it's terribly likely with insurers, we haven't had a ton of them. We've had the one in 2012. We had 3 others since Assuris started in 1987 providing benefits. So what happens here is, we'll look at life insurance as an example. It's the easiest to see example of how Assuris pays benefits. So with life insurance, what happens here is we look at the original benefit, the face amount on the original policy, And Assuris says we're going to provide a benefit up to, 100% up to $200,000. And if the Assuris benefit would be more than $200,000, if that's going to be more than $200,000, then it's just an 85% benefit. So then we're going to look at 85% of the original policy. So if you had an Assuris policy, an insurance policy with an insurer protected by Assuris, your insurance company goes broke, and you had a $100,000 policy, Assuris would pay $100,000 on that. If you had a $200,000 policy, again, Assuris would pay $200,000 on that. If you had a $500,000 policy, that's where it's just times 85%. So we're going to take 500,000 times 85%, and that's going to give us $425,000. That's what Assuris will pay. You'll notice there's no funny math here. It's not a case where we have to do 100% up to an amount and then 85%. It's $500,000. Just gets you to 85%. If you had $1 million of coverage and your insurer had gone broke, again, this would be 85%. That would be $850,000. The only place where the Assuris coverage is a little funny is just when you're around this $200,000 mark. It wouldn't be normal, but let's say you had a $210,000 policy. Well, 85% of $210,000 would be $178,500. That's less than $200,000. Assuris says we'll pay 100% up to $200,000, so they will pay in this case $200,000. So that's life insurance, and that example works well for most of the other benefits that we'll look at. There's different levels of coverage depending on the benefit you have. So with death benefits, for example, your life insurance policy, and this includes group insurance. This would include term insurance, permanent insurance, every kind of life insurance. That's going to be just like we see over here, 100% up to $200,000 and 85% if the amount of coverage would exceed $200,000. If you have a monthly income benefit, such as that offered by disability insurance or offered by a payout annuity, or possibly a long-term care product, then you're going to have $2,000 a month, 100% up to $2,000 a month, and if the Assuris coverage would exceed that $2,000 a month, it's again 85%. If you have a health benefit, a lump sum health benefit, then you would have, and this would be, for critical illness insurance. This would be for travel insurance. This would be for any sort of extended health and dental coverage, such as that frequently offered through group plans. Then you're going to have $60,000 of coverage and 85% if the amount exceeds $60,000. And then if you have a cash value, or we see the same coverage with seg funds, and there is a separate video covering this specifically with respect to seg funds. If you have that cash value or seg fund coverage, and this would include your CSV on a life insurance policy or the guaranteed amount. The guaranteed amount for a seg fund. not the whole contract value, just the guaranteed amount. Then your coverage is going to be based on, again, $60,000 or 85%. And finally, there's a little bit of an anomaly here with the last protection we'll look at, and that's with respect to an accumulation annuity. And with an accumulation annuity, here it's just 100% up to $100,000. There is no 85% beyond that. So you would have no more than $100,000 of coverage on your accumulation annuity. This is similar to a GIC in terms of how it operates, and actually this is very similar to a GIC in terms of its protection as well. A normal GIC would be protected by the Canada Deposit Insurance Corporation exactly the same way as this accumulation annuity would be protected. So in short, pretty much every product you need a life insurance or an accident and sickness license to sell is protected by Assuris. Assuris does provide fairly robust coverage. It does cover with no limit for most products, notwithstanding the accumulation annuity, and it has paid out successfully in instances where it's been needed. I hope this helps you to understand how Assuris coverage works. It's a concept that is tested, and for the purpose of most exams in the financial services field, you do have to memorize these amounts, not just be comfortable with them, but to memorize them. Thanks very kindly. Hope you enjoy your studies.